All right, good morning, everyone, and welcome along to Innovation Bay's regular Wednesday morning event series. I'm your host today, Ian Gardner. I'm a co-founder here at Innovation Bay. I'm also a VC, investment partners at Gelix Ventures. Also on the Innovation Bay team, always give them a call out, Faden Stow, my co-founder, Claire, Sam, CJ, and Alison. We're all working hard to support and connect the startup community across Australia. So welcome. I know there's a few new people on here. If you haven't heard of Innovation Bay, we are the longest running community for founders and investors, and in fact, anyone who loves startups across Australia. Our mission is really to support founders, principally on the journey from idea to IPO and beyond. And we're doing this through a range of events, programs, content like this, all designed to connect, learn and grow. So we are on Hopin, which is a newish platform. In fact, we talked about this in the news podcast, which came up yesterday. Hopin's less than a year old. It just raised money as a venture funded startup, $2 billion valuation. So pretty astonishing growth in it. I hope they iron out some of the technical challenges because we've had a couple. In fact, hopefully Trevor's going to be able to join us because he was struggling to get in. But anyway, we are on Hopin. It's pretty cool. It's kind of like replicating the real world environment. So you've got stage where we'll do the main event, but after the event, we can go and network with each other. So we'll have some sessions and networking, which is a lot of fun. So if you can't hang around, please do so. Couldn't do any of this without our sponsors. So thank you, AWS, IAG Pharmark Ventures, Macquarie Bank, and KPMG's High Growth Ventures team. So massive supporters of the whole ecosystem and us. So I really appreciate what they do with us. Right, this morning, pretty cool topic. I mean, Innovation Bay's got a bit of a focus on angel investment at the moment. I mean, the reality is that ambitious and driven entrepreneurs, and that they're the engine of the world's economic development and job creation. But support for those founders in the early days is pretty critical for these startups and founders to flourish. This is often, normally, I guess, coming from angel investors. So angels are a crucial component of the ecosystem. They're providing funds, expertise pretty early in startups' lives when they need it the most. They're providing talented entrepreneurs, not just with capital, but mentoring, some networks, and they can open doors and fast track progress. Level of risk is pretty high involved in tech angel investing. It's different to other investing. You need a different approach. Angels, they start working and investing in founders because they're curious. They enjoy helping to start and grow new companies. Asset allocation, portfolio strategy, these are always things that we need to make or to think about when we're doing our first investment. So, but the question today is, how does an angel investor build their portfolio? Do you need a broad spectrum of investments, etc.? Look, it is interactive. So if you've got any questions, please join us in the chat and just put them in there and we'll get to them. All right, let me stop my slide share and we shall introduce and meet the panel. So panel, if you're there, then if you can click your magical blue button and join me back up here. Let me just do a welcome. Ariane Barker, CEO at Scale Investors. Welcome, Ariane. Ariane's got 20 years experience in blue chip financial services companies. She was GM of products and markets with JB Ware at NAB in Melbourne. Prior to that, capital market roles. You've been at HSBC, Goldman Sachs, Merrill Lynch. You've been all over the world, Hong Kong, Tokyo, and New York and London. It must be quite a contrast to the last 6 months of being locked down at home in Melbourne. Ariane, is that right?
Definitely learned a lot in the last 6 months. It's been a pleasure. Thanks for having me.
No problem. It's wonderful to see you. Luke Fay is also with us. So Luke is the managing partner of alternative investments, Artesian. Artesian is Australia's largest and most active seed stage venture capital firm. Prior to Artesian, Luke's worked in senior management roles at UBS, ANZ Bank. You've led high growth businesses and high performance teams across Australia, New Zealand, Asia, London, and New York. So welcome, Luke. How are you dealing with that?
To be here.
Yeah, at least you're in Sydney. So, but how are you dealing with no travel? You enjoying that, or is it?
Oh, look, I'm actually starting to miss the travel. It's a fun part of our job at times. I mean, it can be a bit of a burden, but I do like getting out and about, and I'm looking forward to getting back to traveling at some stage. But you know, compared to Melbourne, Sydney's been okay. You know, we can get out and about and do most of the things, and you know, we've been back in the office now for about sort of 3 or 4 months, so that's good. And I'm looking forward to Melbourne, coming out and us being able to travel and meet up again.
Yeah, no, I'm very much looking forward to getting back down there and giving everyone a hug. It must have been brutal. So anyway, it seems to be easing up a little bit now, Ariane. So your numbers are good. Now, Trevor, one of the good things about having a panel is we have a bit of backup if we have technical issues. So Trevor, unfortunately, is having some technical issues getting on to Hopin. I think he's working with Claire to resolve that. So hopefully Trevor Folsom, who's co-founder and chairman at Investable, will be able to join us. I mean, Trevor's really one of Australia's most active angel investors. I think they've got 80 investments. So hopefully Trevor will jump in. Anyway, let's get on and have a chat. It's actually quite fun normally with just two. So maybe just let's start with a little bit about you and the organizations that you're looking at. So Ariane, first, I mean, what is Scale? What's a typical deal? How do you work?
Sure, and thanks again for having me. It's been a really interesting time, obviously, for investors globally, and more specifically for angel investors in Australia, and particularly for us. Started out of Melbourne, but we've got angels all across the country. Look, the way Scale typically operates, and we've been going for about 7 years, is we're obviously looking at deals at the super early stage. And given this call is all about angel investing and how to activate that capital, that's definitely what motivates us and what drives us to get these deals across the line, because we know that we play an essential role in activating that early stage capital. So, in the early days, Scale would typically do anywhere from $500,000 to $1 million in 3 to 4 deals a year. This year and last year, we're well on track to be doing 10 to 12 deals a year. We did 4 deals in 4 weeks last month. So activation is key. Obviously, the pipeline is massive. And for our thematic, which if I haven't had a chance to, if people haven't had a chance to get to know us and have a look at what we do, our investment thematic is backing exceptional female founders. And the reason for that is because less than 3% of venture capital funding statistically goes into female-founded startups. However, the ones that do receive funding or do manage to successfully raise capital tend to outperform, and the statistics on that are 35% outperformance. So, while there's an underinvestment and there's an outperformance, we like to call this female arbitrage, and that thematic has never been stronger than 2020, ironically. And a lot of that is probably the disruption that's going on in global markets, and a lot of folks looking at the way they work and the way systems operate and saying there's a better way, and there's great technology out there. So we're very fast and loose at the moment because the pipeline is massive. Our angel investors are super professional. We've got a network of over 250 sophisticated investors who are really well placed to help deliver on not only capital but also referrals on deals, and we've been super impressed by what we're seeing in markets at the moment.
And who are these angels?
So they're all sophisticated investors. The majority happen to be women, and I know you've got a conversation you want to have about diversity, so we can get into that in a little bit. So we've got about 75% of our investors are women, 25% of these awesome guys who come on the journey, and they agree with the thematic, and they're seeing some great pipeline and some great deals as well. Majority of them are also people who are either ex-founders themselves who have sold businesses and now are in a position to give back. So as an example, Dr. Sandra Mao, who founded Trademark Vision, which had an over 30 times exit, she's now an investor through Scale. She admits that she's been a very successful entrepreneur, but now she's obviously looking to give back to the sector and looking to invest. So she wants to do that through a professional group like ours. Her co-founder, Cameron from Trademark Vision, has also become an investor. We've got women and men from professional services, doctors, lawyers, actuaries. We've got a lot of actuaries, so we've been doing a lot in insurance tech. We've got people like myself, financial services, who again are looking at what's happening in this disruptive environment for financial services. They're very keen and very well placed to help look at some of these deals forensically. And we've got a lot of, this would be cohesive across all of us, but we've got a lot of parents, a lot of caregivers, and there's been a definite thematic around caregiving, med tech, health tech coming through, telehealth, lots of themes coming through with this disruptive environment where our investors are super well placed to have a look at some of the solutions coming through. And determining whether these deals are going to be the right ones to get behind and help back at a really early stage.
Yeah. All right. Look, cool. Luke, let me ask you maybe the same question. I mean, Artesian's a little different to that. So tell us a little bit about the Artesian model and how you think about things.
Yeah, look, there's nothing typical, I guess, about the way I think we look at VC and investing in VC. And I guess in terms of a typical deal, it depends very much on the fund that we're looking at and the specific mandate of the fund. And I guess in that regard, we look at ourselves as a boutique of boutiques. So rather than building up one or two very big funds, you kind of invest in anything. We look to build out lots of smaller funds that can be as small as $10 to $20 million and up to sort of $100 and $200 million, which look to focus on specific areas of the innovation ecosystem where we think that we can see or generate outsized returns. So it gives us that ability to be nimble and fast and agile across those areas. So we have vertical specializations like clean tech, clean energy, food and ag, medical devices. We have geographical mandates like working with the South Australian government, the South Australia Venture Fund. We work with LaunchVic across AI in Victoria. We have stage funds which focus on different stages. So seed stage, which is very early, where we work with Blue Chili and Slingshot. We have angel stage funds where we work with Sydney Angels and other great angel groups like Scale. And we have, I guess, sort of Series A, B mandates or opportunity funds where we work with big institutional investors like Host Plus. So typical for us varies, greatly, across all of those mandates. If I had to categorize it, if we're looking at sort of seed stage opportunities, where we're looking at probably smaller investments, sort of 50 to 300K, and you're probably looking at valuations sub $3 million. And we look at that very much like an option strategy where we're looking to invest a small amount of money in lots of exciting founders with great ideas that are coming either through like an accelerator or an angel group potentially for that support and that network. And we wait for traction. And when we see that traction, we look to follow and invest. At the angel stage, we work with angel groups. Again, rather than actually focusing too much on the specific founders and the business that they run at that early stage, we actually try and focus on the groups and pick the best groups in the country to work with. So Scale, Innovation Bay, Sydney Angels, and what we try and do is work with the groups to help provide an institutional layer or focus to the investing. So we don't want to get too involved in what the group does. That there are lots of wonderful individuals that have fantastic domain expertise, business expertise, that do a lot of that work for us. They help us, I guess, scale that initial sourcing and filtering of deal flow. And then we come in as a co-investor over the top and, again, work with the angel group to help get them to the next stage. And then as they develop, we become much more involved. And then our later stage funds start to take over where we look much more like a more traditional VC. And then I guess, at the sort of series, I guess there's a stage there between angel and Series A, which has become, I guess, known as Series Seed, but let's just call it pre-Series A, where we're looking at getting companies to that Series A. So they've typically emerged from potentially a seed program or an angel program, or they're coming to us for the first time through one of our vertical funds. We're typically investing $500 to $1 million at that stage, and then looking to really drive them through to a Series A, B type outcome. And then there's our opportunity funds, which sit over the top of all this, where we're looking at the very best opportunities that emerge from our funnel. And at that stage, we're looking to invest sort of $1 to $5 million. We're probably much more active at that stage, typically taking board seats and other sorts of things that you would do. But again, at that stage, we're really working to drive to an exit.
And just in aggregate, I mean, like the numbers are pretty eye-watering. So how many portfolio companies have you got, and how much money have you got deployed or under management?
So we've got around 400 under management at the moment. We're approaching 500 portfolio companies. We typically invest around sort of 30 to 70 portfolio companies a quarter, depending on what's going on at the various stages. But on average, it'd be around 50 a quarter that we're investing in.
Yeah, I mean that is definitely the most active out there. I mean, it's amazing how many times we see a deal and Artesian's name is right beside it, because you get in very early. I mean, that's one of the things that differentiates. So, I mean, do you do much?
I guess we do. It's one part of our funnel, and I guess it's part of the way that we generate diversification. But I don't want us to be misunderstood as only very early, because again, early stage for us is seed stage and right out to Series A, B. So we consider all that to be early stage. So a lot of the work that we do, which we would consider to be early stage, is in Series A, B as well, and we'll often invest at the Series A, B stage as well. But you're right. Generally, that the numbers come through the seed and angel programs, and that I guess that builds out our pipeline. So again, something unique that we do that a lot of other funds don't do is that we build our own pipeline. And that's a fantastic source of deal for our later stage funds. But it also helps inform us when we're looking at later stage opportunities in the Series A, B. We have such a big portfolio of early stage things. We have a great, I guess, strategic kind of advantage in terms of how we assess deals at those later stages.
Yeah. Ariane, there was we talked about this again in the news podcast we pushed out yesterday, but the first topic we talked about was I think it was a US headline, but quarterly VC funding for female founded businesses has dropped to a 3-year low. So pretty disappointing. I think everyone's just reverting to what they know and the networks they know rather than trying to get out there. So I mean, any thoughts on that one and why scale is bucking the trend?
Yeah, definitely lots of thoughts, and I'm sure our network would equally weigh in on this one. Obviously disappointing, but again, for us, it's a clear opportunity in markets, because what Scale has managed to do really effectively is we collaborate. We play to our strengths, so we collaborate really well. Luke spoke really well about some of those partnerships, and we like to refer deals to other folks like Innovation Bay. We like to refer deals across the angel network as well, because when we meet these exceptional female founders, we recognize that it's all about the village, and sometimes we're not going to be the only ones investing. And equally, to get these deals done really quickly and effectively, you want to work with really smart investors. So, often we'll look at whether we're leading a deal or whether we're co-investing in a deal. We've had some great inbound referrals this year. Shout out to Matt Allen. He's been really, really supportive. He in April joined Scale about a year ago, and they get diversity. So within the community, everyone's really disappointed, but for us, that opens up a wide chasm of we're the first and only angel investor network for this region to be doing what we're doing. I'd like to think that our brand is well and truly known for that. And we collaborate really well with some of the other female-led groups out there, like Springboard, Head Over Heels, SheEO. And through those networks, we're also getting great pipeline, great visibility. And I liked what Luke was just talking about in terms of informing, strategically informing your pipeline and looking at deals. So, all these deals that are coming through and everything that's happening in markets are effectively a range of data points that we're constantly digesting and, looking to be ahead of the curve, looking to be ahead of the trends, investing super early, activating capital, translating for our investors and for the investor community why we think that some of these deals are particularly compelling at the moment. That's where our sweet spot is, and that is starting to pay real dividends. So, yeah, while it's disappointing, we've had a few people say, if you project forward in, say, 5 to 10 years, is Scale necessary because everybody's equal? And, of course, female founders get an even shot. But unfortunately, those stats just haven't moved. And so, if that's our role, then we'll continue to play that role super effectively because we believe in it.
And I think that, correct me if I'm wrong, but that data, or the data that I talked about there, were from the US. Is there comparable Australian data around female founders getting backed? We've got Trevor.
I'm not sure it's a brand new one.
Trevor Slade, Tech Dragons.
Yeah, it's fragmented and it's hard to get actual real data. I know that a couple of groups, thought leaders, etc., have been publishing various things, but honestly, when we go into some of the granular data that's available in Australia, some people aren't reporting, and also angel data is really hard to get a hold of. So our sense is clearly, and I've looked at this with the AIC, I've looked at this with Innovation Oz, I've spoken to a lot of board members and a lot of groups that are publishing data. We looked at a report that the Wade Institute published about 3 years ago on for female founders. It's really tough out there. And yet you've got this amazing cohort of exceptional female founders coming through, not only sole founders, but also co-founders. And it's really pleasing to see that, groups like StartMate and a few of the other incubators are starting to recognize the power of diversity. And I'm delighted that we're having the conversations about diversity, but those stats have not moved. And my sense personally is that the Australian statistics are probably even more dire than the US ones.
Yeah, depressing. But
I just jump. I guess that the one bit of data that we have is that, and I guess this was somewhat, I think, assisted by our unbiased approach to very early stage investing. Last count, I'll have to update this, but we had about 37% of our portfolio companies had a female founder, which I think was one of the better.
That's good.
Outcomes in the region, and that's something that we're continuing to focus on as well.
Yeah, Trevor, are you with us? Oh, hang on, I think you might be on mute, so you might be able to hear us, but we cannot hear you. I don't know whether I've got control over. No. Well, we've solved the video problem. You might just have to write cue cards for us.
Just while you're working on that, I did want to do a shout out for Artesian, because yes, they do publish their stats and it's pretty impressive. I think almost, not consciously, Artesian's managed to get more diversity through their portfolio than on the other portfolio that we've seen published, which is really pleasing to see. And I know Yolanda does an annual diversity in VC article, and that's where we pick that up.
Yeah. Trevor?
Yeah.
Oh, audio check.
Hey,
taken us 22 minutes, but we have slayed the hop-in tech dragon. So
about 3 devices. Finally unlocked my wife's MacBook to get on.
Well,
so
good work. Let's focus on the content, not the approach. So anyway, welcome, Trevor. So I mean, we haven't got too far into this, so but maybe we should. I gave a small intro to you, just co-founder and chairman at Investible, most active angel investment. I think you've got 80 investments now across various industries and geographies. You've been a successful founder yourself. Look, maybe just for the sake of completeness, can you just outline what Investible is and how you got involved and what a deal looks like?
Yeah, look, Investable's evolved. It's our second coming as a startup ourselves as previous founders, and it's easy to call that successful founder, but I think about all the failures and the mistakes we made in that journey, but we were fortunate to get an exit, so that was great. And then my second coming was to initially solve my own problem as trying to be a successful angel investor and not make the mistakes of others and so forth. So my first 4 years as an apprenticeship was investing my own money, and then eventually alongside other mostly founders who'd been through that journey as well. And then that just started scaling. Once we got to about 23 deals, it was way too much to handle for a couple of us. So we then formed a business around the what was probably a hobby at the start. We hit the numbers we wanted to at first 30 investments. I never forget when I was first inducted into how to build a successful portfolio. A lot of people were talking the 1 in 10 deals you need to be successful to make it, but how do you get to 10? And if you get to 10, the chances of having that success is limited. So 30 was the number that always stuck with us. But then at 30, we need to build a team around that. So Investible evolved. We've now got programs to help with deal flow, programs to help post-investment. But at the core, we are an investment business, which now has a fund and about to launch a second fund, and has a very selective but progressive and innovative group of investors that share in the process, either on the front end on the deal flow or post investment by supporting them.
Yeah. So, I mean, I work with Gelix, and our CEO Andrea often talks about this. The reality is, to your point, Trevor, you need 25 to 30 investments spread across a portfolio to get a return in many cases. So, but that's pretty hard for most angel investors. So, I mean, the topic of today is about how to build that angel investment portfolio. So, any insights or tips in this? I mean, I think, again, one of you alluded to this. It really is a power law business. I mean, you need a handful of your 20 to 30 to hit it out the park to make it work. So, Trevor, I'll maybe keep with you, because you haven't had much airtime yet. So, yeah, can you tell us about how, as an angel out there listening, they should be thinking about this?
Yeah, look, it is interesting. You know, I've now used the word, investable as a business, and the investment. If you look up a lot of the manuals, the angel is some angels are just there to give back and use some time and some invest some capital and enjoy into their retirement. I certainly started that way, and that's my thinking. But then, as soon as you make it a business, it's a pretty tricky one. A lot of other businesses, you can measure success on a monthly or quarterly basis and set some annual plans, and you can measure yourself against that. But when you're investing in this asset class, it's very difficult, because a lot of the investments you make, you won't realize any returns, or certainly any indicators to suggest how you're going. So, but it is a couple of key components. It's volume. You need diversification. You need, obviously a deep portfolio and a great spread. And you also need to, not invest too much too early. So be, respectful of the risks that are associated with this investing, but have enough dry powder to follow on the good ones.
Yeah.
And that's the sort of art form, and it's tremendously rewarding, whether you're in it for the give back and the time, whether you're looking for the returns. But it can be frustrating because it does take some time. So you can only really measure yourself on the quality of the founders you invest in. Yeah. And that is something that is measurable, because you can see their journey and support them, and their ability and their resilience are factors that are good benchmarks.
And Ariane, how do you talk to your investors about this topic of diversification and the power law?
Yeah, and I was listening attentively to you, Trevor, on that, and it's great that you're flagging some of the structural elements. I think the structural elements are really key, particularly for new potential angels considering this asset class. In this environment of effectively zero interest rates, people are looking for growth, and there's been a lot of discussion in markets around where you're going to find that growth. Clearly, the early stage and being able to mitigate your risk profile to get more comfortable is where we're at. Obviously, from an asset allocation perspective, it also makes sense to have, anywhere from 5 to 15% of your portfolio into illiquids, which, as Trevor was talking about, it's all about backing the right founder early enough, but you got to be patient with the fact that you may not see those returns for a good 5 to 10 years. So what we're really advocating, and we have a deep education program available through Scale when people become part of our network, is, again, not investing too much too early, getting comfortable around the risks associated with investing in angel, making sure that you're not hogging up too much of the cap table, leaving capacity for whether it's other angels or follow-on round, and being really clear about what value you as an individual are going to add to that company. And that's what I particularly love about our syndicate model at Scale, which is with the breadth and depth of skills and experience in the network, we can typically tailor, and I'm using that term kind of carefully, but I think it's more curation. When we curate our pipeline, it's largely around the skills and experiences of our network. And we know that there's deep pools of experience and skills there. So, I mentioned earlier that we've got about 5 actuaries in the network. And therefore, we've been able to really effectively do some strong insurance tech deals because we've got those insights within the network. We did a really good deal on Aero with Investable a couple months back, and we met Hannon, the founder, through StartMate when she presented, and I knew that our network wasn't really strong on fashion necessarily, because while we are a majority of women, we're all, very professionally focused and probably not the core demographic. But when we were made aware that Investable was leading around in Aerobe, we knew that there was a great opportunity for scale to add value to that. And we've been able to activate global networks in the fashion communities, in the industry globally. There's a lot going on. So for us, it's about playing to your strengths and trying to get in early and just jumping in.
Yeah, no, that's awesome. Good advice. Look, this question, maybe I'll throw to you, Luke, just came in from James Lau. How much money do you need to get started as an angel investor?
I'm probably the wrong person to ask that. I mean, I'm not an angel investor. I'm an institutional investor. I mean, look, I don't think you need much. I'd pick up on some of the things that Trevor and Ariane said. I think you want to invest relatively small and broadly, and make sure that you're keeping some of your capital in reserve to follow on. I think that's the best advice. I mean, I guess to add to the thematic of the previous question, which I think leans into this as well, is that we come at it, I guess, a little bit differently, and our advice to angel investors is to become involved in groups, like Scale and Investable and others, and get to know and understand, the processes and how to invest and what to look at. And the other thing is look at early stage funds, like Artesian. And one of the ways that we look at it is, okay, well, if you want to start investing as an angel, and say you've got $10 to invest, put $3 in a fund like Artesian's, and get the benefit of a big portfolio, see what's in there, understand what's in there, learn about what they're doing, wait for some of the opportunities to de-risk, participate in angel groups and all the rest as well. And then when you see something that you like that becomes de-risked, something that you can really add value to, start to kind of invest and concentrate your portfolio that way.
Yeah. I mean, I will throw this to Ariane and Trevor. I think are better placed to answer it. I mean, part of the challenge, though, of investing in groups like Scale or Investable, even Gelix, is you need to be a sophisticated investor. So, yeah, I mean, do you want to touch on that and maybe address the how much money you should think about deploying as a startup or a starting angel? Ariane, let's go with you.
Yeah, sure. And I'm conscious that there's been an active conversation around this definition of sophisticated investor for a little while. And look, when I was at JB Weir, we equally had a really good look at what was happening with wealth in Australia. I think it's more a question around the friction costs. Obviously, there's a whole onboarding process, which can be painful. And the other anecdote I mentioned is when I was working in Asia, KYC, know your client, and all the AML rules are super strict. So it was just a given that people would go through that onboarding process, but they probably were using better tech. And here, my sense is that a lot of the community around wealth management have been established over decades of relationships, which were much more high touch. And so now we're in this environment where we've got all this great technology, but we really need to reduce the friction costs to get investors into the ecosystem. Look, the sophisticated investor test, 2.5 million of net assets includes your home. That seems sensible from, being able to make a call on whether you're going to invest into an angel seed round and potentially not see that capital return. But it's really, really important that everyone's educated around what they're trying to do. And I would firmly advocate that that we do more on reducing the friction costs to both investors and founders trying to get access to capital. Yeah.
Trevor, do you think the sophisticated investor rules are sensible? I mean, you can go down the casino and blow $10,000 on blackjack in one hand, but you're not allowed to invest that in a tech startup.
Yeah, look, they're good guidelines. They're guidelines, and I think Ariane and Luke covered that adequately. I think the only thing to add, though, is that there is a broad opportunity now, more so than ever, certainly more than when I started as an angel investor in 2008. There's crowdfunding, so you can put a lot of smaller checks. That makes a lot of sense, and there's definitely a good leverage position there founders as well to close their rounds or to open up to a broader base. And then there's more sophisticated and targeted type groups, angel groups that are probably larger check writers. So and have the capacity to write really large checks down the track, which is important for the founder's journey as well. So it's been selective from the founder's perspective. From the angel investor, Luke and Ariane covered it. There's an education you need to get. So being in funds and joining the club is a great way to do that.
Yeah. Look, so let's talk about there's a few topics I want to touch on. I'll maybe throw it to this one, like co-investment. I think all of us have invested in deals together. Just looking around the room here. So I don't know, my instinct here is that it's more common for earlier stage or seed stage groups to co-invest than it is for later stage Series A and beyond VCs to invest. So why is that, and how do you think about co-investment? So, look, you've got 500 companies out there, so you're obviously thinking about this all the time. So, how do you think about this?
Look, we generally prefer co-investment. To be frank, I think it's great for for portfolio validation, especially if you're following on to investments that you already have. But I think it's also good for funding diversity for the founder and diversity of network and expertise and other things. So generally, we like pulling together a group of investors through a co-investment mechanism when we're making investments. I understand at times that especially when you're getting into that sort of Series A, B, C space where you're really trying to build a percentage stake in a business or protect a percentage stake in a business for from a portfolio construction perspective, and therefore you may be more inclined to look to crowd out other investors to achieve that. But generally, I think co-investment's important. It's an important mechanism for funds as well as founders.
Ariane, any thoughts on co-investment? We talked about this before we switched the mics on. It's like, hey, we've got some deals we should look at together. It's pretty common.
Yeah. Absolutely, and I completely agree with everything that's been mentioned. I think, again, back to my point on reducing friction costs, it feels like we're just getting going in Australia as this really viable, very impressive growth sector of the economy, and everyone's noticing it, and we've definitely seen it at scale with the numbers of angels that have come on board this year. So co-investment is great. I think vetting deals through networks is great. I think we need to remove some of that potential competitive tension, because at the end of the day, we want these founders to get funded quickly and effectively. And that's why I mentioned earlier on that, scale is really moving towards velocity and volume of deals, because we know our thematic is returning, is offering strong returns. So, and to Trevor's point, getting to those 30 deals quickly and not spending 6 months on doing one deal is how we're going to really deliver that growth. So to do that, we can't always do it on our own. And I think the fact that everyone who we've spoken through Scale has been really receptive, particularly in the last year. I remember back in April, and Ian, I think he did a panel back then. What's going to happen? Angels are going to dry up. There's no liquidity. This sector is screwed. But the complete opposite dynamic happened, which was, and we saw this in our network as well, which is people ringing me and saying, what and how are valuations? And they were really, really keen to get in early. And also that market dynamic valuations playing out was a great incentive to get more deals done. And so we've done a lot of co-investment this year, and we've also led a number of great deals. So we're really happy with that momentum, opposite to what we were all potentially predicting back in March and April.
Yeah. All right. We're trying to keep this as interactive as we can. So Claire has created a little poll for us all to jump in. So if you look on the right at the top of the sort of chat box, it says polls. So click on that. We're just trying to find out a little bit about who the audience is and whether you're investors looking to invest or founders trying to get money. So let's fill that in and have a look. So look, one of the things about, there's a question about how you deal, in a syndicate like Scale or Investable, and and maybe to an extent with Artesian, the dynamic of getting your investors to help the founders. We sometimes at GLX sometimes talk about a one-way filter. You want the best help, you want the connections and the advice and the any other goodness that the investors can bring, but you don't want them peppering them with low value add questions like, where's the report? Why is line 23 in the spreadsheet different to what you said? All that stuff. I mean, how do you think about this, Ariane, with your investors and getting them to add value without meddling, if that's the right expression?
Yeah, and thanks for the question, Ian. I mean, we did a lot of work in Scale around managing that balance, because and my firm view is it's all about respecting people's time and respecting their skills and experience on both sides of the cap table. So we curate everything through the office now. We just recognized that things were taking a little bit too long and getting a little bit too detailed, and investors were equally looking for lots of validation before they'd write the check. So we reduced the minimum threshold in Scale. Originally, it was a minimum investment of $25K per deal per individual. We are now at minimum of $10,000 per deal per individual, but Scale itself will typically invest a minimum of $250,000, which we get to pretty quickly by the time we filter through all the data that the entrepreneurs and founders have generously provided, and then we balance that with all the questions that come out whenever we introduce a founder to the network. So typically we take 1 to 3 days to curate all the questions that have come through, work through them with the founder, package that all up, and usually there's about 3 or 4 themes that come through, and then say to the investor group, these are the core of the questions, these are the answers. Anything else is more minutia. Anything else is about adding value to the founder and really activating yourself as an investor and a potential advisor to help this company and help this founder go from there. And that's where the best deals come, where we recognize that there's core skills in the network, as I mentioned before, that, and this has been amazing to see happen throughout the network, where there's a couple of introductions that have been facilitated and the founders are super excited. They said, gosh, that person was really the right person. I really, really appreciated what he or she has brought to the table, and I'm delighted that Scale's doing this. So for us, it's that speed and velocity, but you want to match. And if there's no match, even if it's an awesome opportunity, and we do get deals referred into us, which look like amazing deals, but if there isn't a match or the timing doesn't work, we try and get to that no more quickly so that we can free up their time as well.
Yeah. And Trevor, what about investable? How if you've got an active investor that wants to get involved, like how do you manage that?
Yeah, it's an important part of our a mix of investors, and it's a balance. I mean, we I think those investors select us because at the core we've got a strong team, a growing team of 20 people full time that do a lot of the due diligence, the screening, the post investment support. But when you couple that with the network of investors we've got who typically are relying on us to be that that early profile, our experience and our input, but there's a whole number of them that participate either on the front end because of their profiles. They get a lot of deal flow, but they don't have the capacity or time to do the due diligence required, so they just send them in to us. So they're kind of our scouts. And then we're also scouts for a number of much larger funds who trust our due diligence and look at the detail that we provide for our own investors, but then they're sufficient for that. So, it's a balance. We aren't an open source, so not any investor can just sort of jump on and sign up. We don't market the club as much as others probably do and grow numbers. We're really about quality, both at the founder side and at the investor side. And so we don't have any problems. We are a club in that we engage more than just the investment side. And so that helps as well. Yeah.
Look, there's another question that's just come in from the audience, so I might throw this one to you. And it's around founder education. I mean, like overall, I mean, founders are better educated now than I think they've ever been, just in terms of, what a deal looks like, how to create a pitch deck, and how to approach an investor. But for someone coming into this brand new, it can still be hard to learn those basics. I mean, if you're hanging out at fish burners and the other sort of startup areas, then or the startup hub, it is a little easier to do it. That was the first point of David Hayes' comments, and then the second part was around, I guess, mental health, and support for that is a bit lacking. So, any thoughts on founder education and mental health, Luke?
Yeah, look, I mean, I think you covered it pretty. I mean, there's lots of things that founders can tap into to help with their education, in terms of how to do what they do, and they're, in addition to that and the vast resources that you can get online and other places, you can go through accelerators and incubators and other sorts of things where you can get that much more sort of direct help and advice. That there are, I mean, we were actually running an investor and founder education program through Decode, which is one of our platforms, which again was popular. But look, again, it's one of those things. There's no substitute for doing, and I think that the best way to learn is to do, and you just get started and you do, and you use your network to help inform you, and you start to slowly grow that and reach out to angels and more professional investors, and you get going and do it that way. Mental health, I think, is a good one, particularly at the moment, and it's something that we've been very focused on, especially as we went through lockdown and people working from home and all the rest of it. And again, I think it's really challenging, I think, at a startup to kind of measure and monitor those things, because you're so focused on generating a big outcome, and you're so busy and on that sort of all the effort and time that goes into that. I think it's hard to sometimes step back and actually monitor that, and I think also it can sometimes be overlooked because the teams are relatively small, so you kind of think that you don't need to. But we definitely we're looking at it, especially for our sort of Series A, B companies that were sort of getting to that sort of 50, 60, 70 sort of people stage, and you've got a bunch of people working at home. There's some people in lockdown, some people can go to the office, some people can't. So kind of working with companies to help them sort of work through that. But generally, the awareness, I think, was pretty high. For the companies that have kind of started working through that process and looking to scale, that they're actually starting to put in basic sort of HR policies and processes to help them manage those sorts of things. But look, it's definitely something that you've got to keep on top of. And when I'm on boards and whatever, I definitely try and keep a handle on what's going on in the business, more than the numbers and the data. How are people feeling? What are the things that they, what are the challenges that they have outside of, actually trying to deliver what they're doing that are, they're getting in their way, that, et cetera, and try and sort of help, the founder unlock or unblock some of those sorts of things. Yep.
All right. Oh, cool. Good answer. Let's take another question from the crowd. Trevor, I might throw this to you, but Ariane, you could jump in on this too. A little bit around diversity or diversification of your portfolio. It's from Wilson Casado. So Trevor, I mean, are your deals limited to a geography? He doesn't talk about sector, but you could maybe touch on whether sector. He's asking, are deals? Would you look at deals from Western Australia or even overseas, especially if those overseas ones are looking at the Australian market? Trevor.
Yeah, there's a couple of ways to answer that, and certainly. Just broadly speaking, again, we're talking about the benefits of being in a syndicate or a club. That's one of the key points about having a diverse network, but also having your club spread around the country or the region that you want to invest in. And so that's very important. The best, if you're a Sydney Angel, or if you're in Sydney, your probably network is limited. It's much harder to get access to deals in Perth and so forth. So, we are very purposeful in ensuring that we've got good coverage, not only in Australia, New Zealand, Southeast Asia, and the US and Israel. So we've invested in 8 countries. We've invested all across Australia, and it's a network that helps that. On the fund side, we are an ESVCLP, so we are limited, but that's where our club kicks in. So we'll invest in the best founders and businesses we can find. Right now, there's a lot. We're getting some good deal flow out of Southeast Asia, and certainly much more mature than when we first started investing there 4 years ago. Our fund will be limited and capped on that, but it certainly, the club can invest in those deals even if the fund doesn't.
So, I mean, the rules with an ESV-CLP is 20% can be non-Australian, I think is the official rule. So, you know, whether it's Kiwi or Southeast Asia in your case, I think there's certainly good deals are out there. It's sometimes hard to see beyond the founders that are in, you know, to a broad degree within your network and that you can hang out with and help. So it tends to be that most syndicate groups like this will focus on that. Ariane, any thoughts on that? I mean, you're obviously non-diversified in a sense because you are focused on one type of founder, but I mean, you're looking at deals across the country, but overseas as well.
Totally. So we've invested in early days. We were getting a lot of inbound from the US based on a similar model, but now we're almost solely Australian, just also given the growth of what's happening in Australia. On the diversity point, I think it's a great topic because we've spent a lot of time on managing risk. And, you know, there's a lot of people in our network who sit on boards and who have a really great risk lens. And so and it would be consistent for everybody on this call, which is, you know, you are the sum of your experience. So, you know, the more deals you do, and to Luke's point and to Trevor's point, you know, just start doing, because you'd be surprised how quickly you're going to be able to bring together those data points from your previous experience into the angel investing sphere. And then you're going to be able to mitigate your risk. But that also is compounded by diversification. So while we have this initial screen for our deals, which is there a genuine female founder? And, you know, I can talk to that separately, but we've had a couple of deals that a woman's pitched to us, but she doesn't own a single percentage of equity in the business, which is kind of ironic. We've seen all sorts of stuff come through the pipeline, but yeah, while we have that initial filter, we are industry agnostic. So then it's a function of, you know, the network. And Trevor spoke to this as well. You know, like the club that they've got going on. You know, getting everybody involved and looking at the risks embedded with a particular investment and determining on balance whether it's something that we're going to be able to do effectively and where we're going to be able to grow the company. And those have been the best ones. I've also been super impressed by even, you know, just one phone call between one investor in our network or across the ecosystem and founders can open up huge potential. And again, that's around the diversification. So getting more people involved and getting more eyeballs on different types of deals in different industries is where we're definitely seeing that risk being reduced. And then it's a balance around, you know, making it a personal assessment, but getting in and doing the deals is where you're going to learn the most and also be pleasantly surprised about what you're going to be able to achieve.
All right, so we're within 2 or 3 minutes, so this is probably the last question. And you know, the poll results are in, so probably half the audience are keen to become angel investors. So let's maybe get it focused around that. You know, and maybe just some tips from the panel just on the best way of doing it. So if you're out there, maybe you're sophisticated, maybe you're not, maybe you could give some advice for people that don't pass that threshold. But what are the top 3 things that our potential angels out there should be thinking of to get involved? So Trevor, let's go you, and then Ariane, and then Luke, you can have the last word. So Trevor.
Yeah, look, no doubt all of us will agree it's about the founder. But if I broaden that to the people involved, it's more than the founder. It's important to do some due diligence around who their advisors and key people are, and equally who their current investors are and who are you going to co-invest with. We do a lot of work on that side. We talked earlier about you know, co-investing, and it's an incredibly important part. It's what our model is. We co-invest with our club and with others, but it's not easy. Everyone has good intentions to do that, but there's certainly some pretty average examples as well. So whether you're a founder or an investor, the terms that are set and you know, potential predatory terms or not even intentionally predatory tripwires that can, you know, impact the founder. If you're truly investing in the founder, it's about trying to make their chances of success as you know, highly successful as possible. So it really is important to not only do your due diligence on the founders, but the people that surround them, and certainly the people you're going to invest in or already invested or propose that they are advisors. And we know founders are now very skillful at attracting people and putting them on their decks. Are they actively involved? And if so, what capacity and what do they bring to the table as well?
Ariane, do you want to answer this, but with maybe a bit more focus on just if you're not an angel, but you're thinking about it, what would you be advising them?
Yeah, and it's a really good point, because I know there's a bunch of people on this call who have reached out to me offline to say that they were looking to get more information on this call. And I think obviously joining a syndicate group like Scale, we work collaboratively, is one of the best ways you're going to be able to get that comfort. So it's about balancing building your confidence, and doing it with a syndicate group like a Scale will allow you to actually get curated, filtered pipeline from day one. You don't have to go out and hunt your own deals. The hunting's being done for you. You've already got the relationships embedded in the network across the ecosystem and with strong founders coming through. And then you can really focus on what is it about this asset class that you're excited and interested in, and how can you get comfortable to write that first check? Because, you know, with all respect to the ecosystem, if we can't get those checks written, if we can't activate capital, then it's just a conversation. And I really, really want to, you know, double down on this activation of capital thematic, particularly in this interest rate environment and what's happening economically, because the companies of tomorrow are being built now. And if they don't have access to capital, we haven't done our jobs properly. So for any prospective angels on the call, you know, obviously reach out to a group that you've got a connection into. Rest assured that there's some great connections across the ecosystem. We're all about helping you build that confidence and managing your risk profile to write that check. And doing it through a group is a great way. Equally, if you want to do your own thing, you can join an angel group to get access to awesome pipeline. Then it's a conversation with the founder about not messing up the cap table, because we know that there's some people who just like to do their own thing. Yep. And we get that. But I think to Trevor's point, there's a couple of average examples out there as well, and nobody wants to see a company fail because of an incorrectly structured cap table from early on.
Look, we're over time, but
I'll keep it quick. Lots of small tickets would be my first advice. Join groups, networks, and plug yourself in, get involved. And the third thing is use funds like Artesian, you know, small amount of money into the funds to build your pipeline alongside groups like, Investable and Scale.
Yeah. I should probably throw in a plug for the Innovation Bay Angel Club. I mean, that's part of the reason we've got this theme going on here. So Sam Clark, who's just joined us in Melbourne, or not just, actually 3 months, Sam. But she's going to be helping us roll this club out. So after the session and hop in, we will be doing a room with Sam. So if you want to find out about that, then join the room, and I'll probably jump in there, and Sam and I can take some questions and some tips. All right, look, that is it for the official part. So Ariane, Luke, Trevor, when you finally got here, thank you so much for participating. If you can hang around, great. And Luke, I think you've got a 9 o'clock call, so you better jump on that. So if I can ask you all to click leave and skedaddle, and I'll just run through the last little part of today's wrap up. But thank you all for joining. So yeah, if you all click the leave.
Thanks, Ian. Thanks, Ariane. Thanks, Trevor.
Good to see you, Luke. I'll see you guys in the networking.
Yeah. All right, let me just do a quick wrap up. So we are going to switch on. I think Claire's already done it. So the sessions and networking are live now. So you'll see you've got the red little tile on the left side of your screen. So we can join the sessions for group conversation. So we can continue the discussion around what we were just talking about, or there is going to be a room talk with Sam and me talking about the Angel Club. So join us there if you can. Upcoming, so we've got one more of these. We may actually be putting, the brakes on a little bit. We want to get focused again on face-to-face events. So, I think we'll be dialing back a little bit our virtual events like this. So, but next week we have another awesome one. So, who sets valuation in deal terms? Slightly different format. So they'll both be giving a short presentation. So we got Melissa Widner, who's at Lighter Capital, ex-NAB. So she's comes from both the venture side and the founder side, so fascinating. And Rory from Propeller, so came out of StartMate. Propeller's raised a ton of capital. I think it's like 40 or 50 million now from people like Excel, Blackbird, and some great investors. So he's an amazing founder. So that will be a terrific event. Same time next week. We're also still looking for agritech applications for putting them to our Angel panel. shortly. So that's closing in just over a week. So if you're in AgTech or you know anyone, tell them about it. I mentioned this before. We had a great conversation on the news panel. We recorded on Monday, put out yesterday. So we had Sam Wong, Ron McLuhan, and Mick Lubinskas. So awesome conversation. Check that out in the podcast. Thanks again, national sponsors, AWS, Pharmark, KPMG, IAG, Pharmark, KPMG, High Growth Ventures, and Macquarie Bank. That is it. I am going to switch my slides off and go and join the networking. And thanks for joining, and I'll see you next week or in the networking now.